Hi, and welcome to another segment of Freeman CPA. My name is Greg Freeman. I'm here today to speak to you about penalties. There are so many different types of penalties. We always joke here that it's like Baskin-Robbins 31 flavors. If you guys remember that commercial, then you're probably as old as I am and you're dating yourself. So let's not go there. Basically, the IRS has many different ways of issuing us penalties. And that's the way things work in this country, right? So if you're speeding, you're going to get a ticket, you're going to get penalized. And this is the same thing with our tax system. So if you're not following the rules and you're doing what you need to do on your own without any regard to the tax law, then you might get in trouble with the IRS. And there obviously are different levels of trouble you can get into. So why don't we discuss a little bit about all these different types of penalties I have listed out, and I'll quickly just go through them and give you my 2 cents so that way you guys can stay out of trouble. All right, so why don't we start with the first one? This one's actually the easiest one to avoid. Failure to file is the one I'd like to speak about first and foremost. And so if you get to April 15th and you're not filing your return for whatever reason, and you're going to avoid that situation and you're not going to file for an extension, you're automatically going to be deemed late. And if you did not file for that extension, therefore, you're going to get penalized for failure to file. Now, all you have to do is submit an extension, and all of a sudden, your taxes were extended. That buys you 6 months to file your taxes. Again, this is not an extension of time to pay your tax. This is just an extension of time to file. We have videos up here that discuss exactly how to make payment and what it means to actually extend and pay your taxes, because those are really two different things. So simply filing with I don't owe any money, like a 0, wouldn't be actually correct, because you'd want to send in if you do owe anything. Although that doesn't necessarily mean that you owe something if you're applying for an extension, but most people might owe something with their filing, so you don't want to be late on that payment either. But if you don't extend and you don't pay, then you just added yourself an additional layer of penalties. And failure to file is actually penalized much more than failure to pay. So failure to pay is actually worse, is actually not as bad, rather, as failure to file. Believe it or not, you would think that paying is actually more egregious, but no, it's quite different. And so that brings me to failure to pay. So yes, obviously, if you don't pay your tax when it's due, and no, it's not due April 15th. It's due throughout the year. We have videos that go through this. Again, that's the same video that I referenced earlier. That is basically, the taxes are due on a pay-as-you-go system. It's not a pay by April 15th system. If we have income, then we have to pay tax. If you're working on a W-2, somebody's withholding taxes for you. But if you're self-employed, nobody's doing that. So a separate conversation, let's move on. So there's a lot of these failures, right? So I'm going to skip over fraudulent, failure to file. I'd like to talk a little bit about, because I'll get back to fraud, and fraud is its own flavor, but let's talk more about failure to deposit employment taxes. Now, if you're an owner of a business and you're withholding taxes as an employer, so in other words, you're cutting somebody a check, that person gets a net pay from you. In other words, if they earned $1,000 and they receive net of taxes, let's say $776 after you've withheld taxes, and then you're supposed to add your employer taxes, you merge them together and you send them out. So you're basically in the middle. So you're the tax collector for the IRS in such a case. So the IRS is actually entrusting you with the taxes. So that's why payroll taxes and sales taxes are considered trust taxes. And if you do not collect it and remit those taxes over properly, the government sees it as you're stealing from the government's pocket. Because think of it this way, if I cut a bunch of checks to an employee, I collect the taxes, I hold on to them, I don't remit it over to the government, I just stole money. And then that person goes and has to file their taxes with this W-2, and they're going to claim that they already paid the taxes, so the government has to issue a refund. to that person but where did the money come from? They had to front your bill. So it's also a very serious tax law to break. And that's why they're also penalized incredibly heavily. And actually, you can't even hide behind the entity because they will go after you personally. So if your entity is the one that's operating and withholding taxes and it's all happening under your entity tax ID, and you think that if you close your business or go out of business and go bankrupt, that they can't go after you, they actually can. The logistics are very obviously convoluted, but you should understand that it wouldn't just disappear nilly-willy. It can actually go as far as losing your driver's license if you're like in a state like New York, or you can lose your U.S. passport if you're a resident of the United States. All right, so that's a failure to deposit employment taxes. These are the details. I don't want you guys to like really try to understand how to calculate these because they're not simple calculations. There's actually specialized software that we use that mimics IRS software, so it's not readily available to be able to recalculate the penalties issued automatically by the IRS because of the way it's structured. So if you're looking at some of this jargon here, yes, this is the official amount that they're going to penalize you, but it actually is very hard to recalculate. You can't just grab a calculator or an Excel worksheet and double check their math. It's pretty complex. And yes, there is specialized software just to do that. All right, let's jump to the next one. So failure to file informational returns, and then failure to furnish payee statements. So what's an informational return? Informational returns are tax returns that do not carry any income tax when we're finished filing them. So in other words, an S corporation, a partnership, an LLC, Forms 1099. These are all examples of informational returns. A lot of foreign reporting, assets held abroad, or transactions between U.S. foreign-owned companies and the transactions between parent and sub going back and forth. These are all great examples of informational returns where the government just wants to know, hey, I paid a subcontractor, he needs a 1099, and then that subcontractor has to report their fair share of income because I'm reporting the 1099. Or I have money leaving the country, or I have money coming from another country into this country, and FinCEN, which is the Financial Crimes Enforcement Network, which is not the IRS, wants to know about it because of terroristic acts in the past. So they want to know whenever any kind of money is coming and going out of the country. So it's all done for our protection. But again, these are informational returns. So we file, there's no tax due, there's no tax liability that comes of it, but they're still heavily penalized. All right, so those are some of the examples of informational returns. Now, what do they mean by failure to file and failure to furnish? So failure to file means, as it says, I didn't file with the IRS, my 1099, but I also didn't furnish the vendor the 1099 that I was supposed to, right? So they want to do a double whammy. Now, with those in particular, I'm yet to still see penalties come out of that, but I do suspect that with this $8 billion funding that the IRS just received, we're probably going to see a lot of new letters coming out of the IRS in the form of tax notices, and they will be going after taxpayers. And most likely, these are one of the areas that we suspect we're going to see a whole new set of enforcement action coming out. All right, so let's see if that brings us now to fraud. Fraud is the worst thing you can do, all right? I think that was like the first thing out of my very first tax class I've ever taken back in the day. And the professor was talking about fraud. And of course, we're going to talk about Al Capone, the famous Al Capone case. And he's like, I think, one of the first ones that go down in history for tax evasion, right? Which is kind of like similar to fraud. But actually, it all kind of coincides. This is like the evil stuff. This is the stuff that like everyday people aren't even going to think of doing, right? So fraud, tax evasion, these are all ugly words. These are all words where we're lying, we're cheating, and we're maliciously trying to avoid the tax and basically blatantly going against the rules, right? So what is an example of fraud? Well, fraud is identity theft and trying to file taxes on behalf of other people. And we've seen this happen very frequently. You know, there's these instances of these tax professionals that will form basically like shell companies that don't actually exist as like no people or anything. And they basically report, you know, write-offs, and they reflect information that's completely inaccurate in order to produce some sort of favorable tax refund. And so they're basically lying and creating false information, and that's the biggest no-no on this planet. And similarly with tax evasion, you know, the Al Capone case. So like when Al Capone got caught and went to jail, he went to jail because he evaded tax. He wasn't paying taxes on his income that he was earning illegally, right? So yeah, and my professor said that. He's like, hey, if you're selling drugs, if you're doing illegal activity, you should still be paying your taxes because that's still taxable income. Remember, gross income is taxable income from all sources unless specifically excluded from the code. So unless the code specifically says disability income is not taxable under this, that, and that situation, then it's taxable. I don't care if you're selling lemons in the lemonade stand. That is one thing that people don't understand. Every now and then I still get a client that will call me and says, shh, oh, between me and my brother or my sister or my son, I have this arrangement. Do I really need to tell somebody? Well, if they're paying you income, of course you have to tell. How can you even ask me these questions? So yes, that client is basically fired a long time ago. We don't try to work with people that even murmur something along those lines, but it does come across. I mean, I've seen everything now. I've been in business for quite a while, so definitely along the line, somebody's come around and asked me silly questions like that. Do I need to report my income? Yeah. Anyway, so that's tax fraud, tax evasion, but there is a thing called tax avoidance. So tax avoidance is what we specialize in. So we help people avoid tax legally. And that's the key difference between tax evasion and tax avoidance. Tax evasion is what Al Capone did, where he was basically receiving taxable income, was not paying anything, any taxes on it. He went to jail for tax evasion, not murder, not any other awful, awful thing that he was doing, but he went to jail because he skipped out on paying the IRS. And then tax avoidance is when you come to me and we figure out a right structure for your entity to legally minimize your tax impact and save you a couple of $1,000s or maybe 10 or maybe 20. It depends on your situation, what it is that you're trying to do. Can you pay zero tax? In theory, you can. And it does happen sometimes, but it's not very easy to set up, and it will definitely apply to very limited situations. Let's face it, folks, everybody out there on TikTok is trying to sell this pay zero tax thing. It's really not that straightforward. And unfortunately, if you want to pay zero in taxes, unless there's something that's really coming in out of somewhere, like a big R&D, research and development credit, or maybe you have like huge carryover losses from a prior year that weren't used, and all of a sudden you have zero tax, it is very difficult to get you to a zero tax due situation without having to shell out pretty much everything you've earned. Now, that's the way it works. All right, so we talked about fraud. Let's see, so let's go back here. So we did failure to pay, failure to file, fraudulent failure to file. So same idea, I'm just creating fraud, but now I'm actually fraudulently failing to file because I'm trying to say that I don't need to file or something along. Again, fraud. Guys, if you're an honest folk, you're not lying, you got nothing to worry about, you can sleep safe. I'm sleeping safe. Believe me, all my clients sleep safe at night. It's never an issue. That's what we do best. We give people great sleep here. That's what we get paid for. Insight, knowledge, experience, expertise, but a great night's rest. All right. Let's talk about, so we talked about evasion, we talked about fraud. Let's talk about failure to collect or pay over tax. I mean, that's also, again, I'm not even sure of which situation that really entails, but I'm sure that's a very specific situation, one that I haven't seen. So it's a little bit ambiguous to me. I guess you're supposed to collect and to remit it over, but you didn't. So I guess that's neglectful in a way. perjury and fraud. So we talked about fraud. Fraud is obviously knowingly, maliciously lying and creating things of all fake sorts of things. You know, like I've even heard of people like stealing dead people's or identities and then filing for refunds. I mean, this stuff is sick, but yeah, it happens. So that's fraud. Let's skip over fraud. Let's jump to perjury. Perjury is what we signing when we sign the return. So under penalties of perjury, we sign the taxes as your tax professionals, and our clients are signing alongside of us, basically stating under penalties of perjury that everything on this tax return is accurate, complete, and correct to the best of our knowledge. In other words, we did our math, we did everything as best as we could, and tried to really not make any mistakes and didn't falsify any information on the tax return. So, and a great example of this, which comes up all the time in practice, is the 1099 question. So we just talked about the informational return 1099. Now let's put it into practice. Yeah. So when you're issuing a 1099, or when you're supposed to issue a 1099, it's a certain set of circumstances that come into play. So if I paid a contractor, let's say via check, let's just make this simple because this video is not about 1099. This one is. But if you're supposed to issue a vendor 1099, so in other words, they came, let's say in your business, you have a plumber that's going to come and help you fix the drains in your place of business. This is not a home office situation or your home situation. This is a place of brick and mortar. You hire a plumber for your kitchen, for whatever part of your business. They come in, they do the work, you cut them a check, they cash the check, they're an LLC, and you pay them over $600. You just basically found yourself in a situation where you have to issue a 1099 NEC form, non-employee compensation form, or what we used to just call 1099s for short. So you, as this business owner, now have the obligation to collect data from this individual in the form of a W-9 form, and they're supposed to complete it. And they're supposed to basically give you their tax ID, their business name, what kind of entity they are. So it's a little bit of self-reporting here. And when you obtain this information, this W-9 form with this request for information form, you basically complete that 1099 NEC. And then you issue that 1099 NEC over to this vendor so that they can pay and remit over the taxes on this taxable income, right? Now, every single business return, whether you're having a rental, whether you're having a Schedule C business, like a small mom and pop sole proprietor, or just, an LLC, self-employed something, or even partnership LLC, doesn't matter. Corporate, it doesn't matter. Any business return is going to have this question. It's going to say, were you supposed to collect, were you supposed to remit over and file a 1099 NEC? Did you have this situation? Did this situation pop up, right? And obviously we should know what the rules are and what actually should trigger us that situation. As I described, it was over $600. There was a check that was written. It wasn't paid by like a credit card where there would be a 1099K issued in its place. And obviously it was an LLC owner, so it wasn't like a corporation, like a big corp, where I'm not required to issue. So it met all of the requirements for 1099 NEC compliance. And so the question asks, did you have this situation where you met all the requirements and you need to issue a 1099 NEC? And then you have to answer affirmatively or negatively, yes or no. So I, as the tax preparer, have to not only educate my client on this, but I also have to check the box and say, yeah, we actually issued all the 1099s NEC. Yes, we had this situation. And then the follow-up question, well, if you checked off yes, then will you or have you already issued these 1099 NECs? And then you have to follow up with a yes or no. So that's an example of when we're answering questions on a tax return that don't actually change anything within the calculations of our taxes or tax liability rather, but it's actually still declaring that I'm doing something here that I should have done or I didn't do. So that's very serious. I haven't seen any penalties for that sort of attestation where, when you're saying, yeah, I had to issue 1099s, but I didn't do my job. I haven't seen any penalties still circling back to informational returns. And that's what I was referring to earlier. So even though we'll mark, yes, our client needed to do it, but no, unfortunately, that vendor is gone or whatever, so we're still going to mark no, we didn't comply. We still have not seen any penalties come out of that. So it might happen. I doubt it, but it might. Anyway, so that's an example of, doing perjury. In other words, I'm signing a return, and just there's a lot of words there when you're signing, and that's your perjury statement. And it says that I'm basically really swearing here that this information, everything on this tax return is accurate and complete to the best of my knowledge. So look over your return, folks. Don't ever sign the return unless you really looked it over. At the end of the day, it's still your tax return, and ignorance is never going to be a way to get out of trouble. Unfortunately, in our tax system, that's just how it works. All right, just going to quickly discuss one more situation here, which is really the earned income credit. So the earned income credit, if you have income that you've earned and you're in a certain income bracket, then you'll get a tax credit. Back in the day, there was a lot of negligence going on with these, and everybody was trying to get as much of this earned income credit because it was so sizable. So people were actually falsifying that they have dependents and that they don't make as much income just to try to get themselves into that very sweet spot where they don't have too much income, they don't have too little income, and they have enough dependents to get a big fat check from the IRS. And people would do this all the time. They know a relative that has a child that doesn't need to file, so they would borrow his social and put it on their return and maybe borrow a couple more socials. All of a sudden, you got 3 kids under the age of 18 as your dependents, and all you made was $40,000. Oh my, how sad. Yeah, well, the IRS would give you an $8,000 check for that so you can go get your TV that you've been waiting for. And that's earned income credit fraud. All right, happened many times. I'm sure it's still going on. I don't know to what degree. We don't have many earned income credit clients here. That brings me to the very last point. As far as the penalties are concerned and our flavors, is the accuracy related penalty, and that's us as well as the taxpayer as well. So yes, you guessed it. If you're not accurate with your filing and you forgot to give your tax accountant 3 W-2 forms and you forgot to mention a whole boatload of things, then you just basically put you and the accountant in a very bad position, because now you're getting slapped with accuracy related penalty, which is going to be pretty big. And then you're going to come back to the tax professional and say, hey, how come I got this penalty and why is it so much? Well, that's because they really penalize big inaccuracy. So if you missed a certain amount of income and it's a certain percent of your income that you missed, hey, you're not accurate enough. You should have crossed your T's and I's just a little bit, crossed your T's and dotted your I's a little bit more carefully. All right, that's the accuracy related penalty, and it can be issued on the taxpayer as well as the professional. So just because you don't see it here, it doesn't mean it doesn't apply to us. There's even more penalties that will apply to us as tax professionals than there might be for tax, more heavily penalized ones than for individuals, because we carry that much more responsibility. All right, that's that. Can we get out of this? Of course, hire the right professional. Do your due diligence, come prepared, come early. Don't do things without first asking, and prepay your taxes. More likely than not, you'll be fine. But what happens if you miss something or what have you? Nobody's perfect. Everybody's gotten a traffic ticket. Everybody's gotten something, right? Nobody here is perfect. So what do I do if this one time I get into some sort of boo-boo and now I need to get out of it? Well, if you remember Monopoly and I get out of jail free card, well, the IRS has something for you. So it's called the first time penalty abatement down below here, or the FTA for short. And it's not a one-time deal. You can use it if you haven't used it within a 3-year time period. You can get to use it again. So it's not just like a one-trick pony. You'll actually get to use that a couple of times, but within a certain time frame, you can only use it once, and only if you didn't use it before and you didn't have penalties before. So there's a lot of red tape with that one, and a bunch of check boxes you got to get through before you can actually make that actually waive the penalties, because you're just waiving a law. And you literally call the IRS and say, hey, I got this penalty once, I've never been penalized, and it has to get in certain types of tax types. It's not every situation. But yes, there will be a first-time abatement clause, and you can literally call them and say, hey, I had this one time, I've never had another penalty, I've never asked for this kind of abatement, would you just do me a solid and give me a slap on the wrist and let me go? and they will immediately let you go. So that's my tax tip for you guys today. If all of a sudden you got into trouble, consider the first time abatement penalty clause. All right, folks. Well, thanks so much for joining us in another wonderful segment. I hope that this brought a lot of value to the table and that it'll help somebody learn more about the tax system and learn how to keep up with it. It's a complicated system. We feel your pain, and we know that it's not an easy system to navigate. We're hoping that someday all of this will somehow get simplified, that the code will get simplified as we're seeing now AI coming out. We're going to be seeing probably a lot of different changes. Unfortunately, there's still a lot of legislation that comes into play, and we never know exactly how things will pan out. But we're going to do what everybody else does, is we, hope for the best and prepare for the worst. All right, guys. Remember, your success here is our success all day, every day at Framin CPA. Thanks, and have a wonderful day.